You are in your 20s, staring down a mountain of student loans or credit card debt and feeling completely locked out of the wealth building club. It is a frustrating place to start. The financial industry thrives on making you feel unqualified to manage your own money. They rely on confusing jargon, massive spreadsheets, and intimidating charts to convince you that investing is a job only they can handle. This flowchart outlines the exact crossroads you face today. Starting with just $50, you have two choices: hire an expensive professional to chase market trends, or bypass the gatekeepers entirely with a straightforward system. If you follow the expert path, you pay a premium under the assumption they can beat the market. But those complex strategies usually involve excessive active trading, and the resulting transaction fees simply drag down your actual returns. The alternative is the automated blueprint. The biggest barrier to your financial independence is not the size of your current paycheck. True wealth relies on a simple system that runs in the background. Knowing this, your immediate instinct might be to pause all investing until every last cent of your debt is wiped out. But delaying your investments entirely to focus solely on debt costs you your single greatest asset: time. You permanently sacrifice the early years of compound growth, which is what actually does the heavy lifting for your portfolio later on. It is incredibly tempting to try and pick the next Amazon or Tesla. Beginners often spend hours researching emerging global trends, hoping to guess which single stock will make them rich. The math on that approach is brutal. If you put your money into a single company or sector and it fails, your capital is wiped out. You are taking on maximum risk for a completely unproven reward. This comparison matrix breaks down the alternative. Instead of betting on one company, you can buy tiny, fractional pieces of the 500 largest companies in the US all at once. This mechanism is called an index fund. Think of it like walking into a grocery store. Instead of trying to guess which single apple in the bin is the absolute best, an index fund lets you buy the entire produce section for a fraction of the cost. There is a trade-off here. By buying the whole market, you forfeit the lottery ticket chance to double your money overnight. Trading those short-term thrills for mathematical stability is the required cost of entry. Historically, a broad market index returns a reliable average of about 10% a year. Active trading also requires you to be glued to a screen, battling constant anxiety to monitor your positions. The index strategy runs entirely on autopilot. Accepting the boring, predictable performance of an index fund is mathematically superior to taking on the catastrophic risk of concentrated stock picking. Consistent time in the market will consistently beat trying to time the market. Trying to buy in at the exact lowest point is a dangerous gamble. It is exactly like trying to catch a falling knife. You are highly likely to get cut. The actual mechanism for growth is compound interest. Imagine a snowball rolling down a massive hill. It starts tiny, but the interest you earn begins earning its own interest, accelerating automatically as it grows. This graph charts that exact trajectory. Making consistent, small investments early in life leverages that curve far better than waiting decades to invest a large lump sum. The hardest part of this process is emotional. The stock market is a roller coaster, and significant crashes are going to happen. When beginners see their portfolio turn red, fear takes over. They panic and sell their investments at a steep loss just to stop the bleeding. The professionals actively rely on this panic. When you sell out of fear, they swoop in to buy those exact same great companies at a flash sale discount. Market volatility is entirely normal. Holding your investments firmly during a drop is how wealth is successfully transferred from people who panic to people who remain patient. There is a hidden cost built directly into the traditional Wall Street system. Financial advisors typically charge a standard management fee, usually around 1%. 1% sounds virtually harmless, but over a long timeline, that tiny percentage creates a massive drag on your momentum. It is like rowing a boat across a wide lake with a small hole in the bottom. You won't sink immediately, but you are going to work twice as hard to reach the other side. This data visualization illustrates the objective mathematical damage. Over 30 years, a 1% fee can eat up nearly 30% of your total potential wealth. You took the risk, and you applied the initial capital. But the effort required to earn that lost 30% is essentially wasted labor, transferred directly to enrich the middleman. Managing your own money through low-cost index funds completely eliminates that middleman. You cannot dictate what the market does on any given day, but minimizing your fees is the single most controllable factor you have to ensure your compound interest stays in your own pocket. Active, trend-chasing stock picking is built for speculators with disposable income who want to treat financial research as a high-risk hobby. The index fund blueprint is for time-poor beginners and professionals who want a mathematically proven path to wealth without constantly checking charts. The scorecard for winning this game is straightforward. Start early to leverage time, buy the whole market, hold steady through emotional drops, and cut your fees. From here on out, you can safely ignore future market fluctuations and focus purely on consistent, long-term accumulation. Ultimate financial freedom is not built by outsmarting Wall Street. It is built by refusing to play their high-stress, high-fee game in the first place. To apply this strategy right now, click the video on your screen titled First Investment Guide, From Zero to Investor in 10 Minutes. You will see the exact click-by-click setup of your first account. I will see you over there.